Well, hello everyone. We will give it another couple minutes as we've got about another waiting for another 100 or so attendees, and so we'll get going at 11:03 Pacific. Well, all right, guys, we're going to go ahead and get started. I appreciate everyone for joining our current market recommendations titled webinar here. Look, the reason rationale for the webinar is, simply that while while the market movements caught a lot of market participants by surprise, we're now in the really in the top three most volatile periods of the last 10 and arguably last 20 years. So the periods that, the last 10 years, of course, are, 2 years ago, March 2020. And then what we're going to compare and contrast today against, because there's a lot of similarities, is the taper tantrum of May and June of 2013. And there's, again, a lot of similarities there, but there's a lot of good news as well, as far as a much more orderly market movement, and also a much stronger price action correlation, I should say, from the aggregators and the agencies and just the whole loan community. So I'm going to get right into it. For those of you that have been on webinars before, this is kind of our standard group here. We're going to have Andrew Rhodes, who's our director of trading. He will speak to some of the trade desk recommendations, some coupon liquidity issues that we're currently seeing, where we're seeing good liquidity, bad liquidity, where we're seeing wide bid offer spreads, and some trade desk recommendations on how to handle that when you're trading, when you're hedging your pipeline. And then, of course, we've got Justin Grant, who runs our investor services, and he'll be talking about investor price action, just what we're seeing as far as the aggregator performance, as far as agency performance, and what we can kind of extrapolate out from what we've been seeing versus, for those of you that were hedging 9 years ago, during the taper tantrum when we saw some substantial, decoupling. So, jumping into the agenda here, I'll review the recent, the market movement that we've had, again, compare it and contrast it to what we've seen in the taper tantrum of 2013. Andrew's going to go over some coupon liquidity recommendations, and then after Justin, I'll go over some new indice analysis that we have in MCT Live for you guys, that's available to everyone. So just gonna kind of moving over to what we've seen in the last 30 trading days. It's been, obviously very volatile, since if you think of last week of February as the initial Ukraine war price action, we had this 150 basis point rally, and you can see that from here in the left side of the graph, from February 23rd basically to the beginning of March. You get this basically 1.5 rally, and that, if you think about it, just looking at the graph in its entirety over the last 30 trading days, that really kind of accentuated some of the volatility that we've seen. Right, there was obviously concern, a lot of concern that from a geopolitical standpoint, which obviously that concern is still out there. But there was that initial flight to quality, which created a rally in the debt markets, and pushed prices further, pushed prices up. And then, of course, things turned around. And so basically over a 3-week period, you had a deterioration of about 450 basis points in the market coupon. When we push that out over the period of Q1, you can see just how substantial this move has been. So we basically, it's basically been kind of a 2-step move. You had basically January, where we dropped about 300 basis points, and then February we traded sideways until, as I just talked about, we moved up 150 basis points because of the Ukraine war. And then really when the Fed and subsequently Powell started talking about the extent of the raises that they were going to continue to do throughout the year, that's when you saw this next step of basically an additional 350 basis point drop in the market coupon. So in total, we're looking at about about a 650 basis point decline in the market coupon over Q1. So definitely a huge move, and there's a lot of it's definitely a big move. But I want to highlight here that this is, it has been, notwithstanding last week, relatively orderly, given that it's taken, you've seen this kind of broad decline over a period of basically all of Q1. And what that's helped allow the investor community, both on the aggregator and the agency side, as Justin will show in graphs later on in this presentation, that's allowed the investor community to really perform from a standpoint of price deterioration. And what I mean by that, about perform with price deterioration, obviously pricing is going to get worse as we see the market deteriorate. But what we saw, if we take take the last two, the other two periods of volatility in the last 10 years that I described, 2013 and 2020, though there were substantial decouplings. Obviously, 2020 was a huge outlier. But even if we look at 2013, there was a decoupling between aggregator pricing and security pricing, and that obviously is a problem if you're hedging with TBAs. Part of the reason for that is the how quickly the drop occurred in 2013. There would be, the aggregator community really just was concerned about at the time of catching a falling knife. So when we look at this graph, again, we're talking, 650 basis points, 6.5 point drop in the market coupon, because again, the market coupon back at the beginning of this year was a 3 coupon. And that was over a period of a quarter. If we move to what happened in 2013, you can see that we dropped 930 basis points over a period of basically 2 months, but we had 2 holidays in those 2 months. So it was actually a period of 38 trading days. We dropped over 9 points. And so you can see that, not to, there's a lot of reasons that we don't want to give the Fed credit, right, for maybe missing the boat on inflation. With all that said, there's definitely been a more orderly decline here today versus what we're looking at here that occurred in 2013. And so that's, from a security standpoint, I think what I want to make kind of underscore to everyone here is that we have, we've definitely been here before. It's a little bit uncanny, the similarities, right? We were the market coupon when this all started in, when the market started deteriorating this year, was a 3 coupon for conventionals, a UM33. Back in May of 2013, it was a Fannie 3, and the price action is similar and severe, but not quite as severe, and not quite, and it occurred over a much longer period of time. So I think that's that's definitely something to understand here as we're looking at as we compare and contrast. So one of the advantages of the kind of the slower drop versus what we saw in the taper tantrum is we have better liquidity in the we have better liquidity here. And sorry guys, let me go back and we have better liquidity in the lower coupons. And I'm going to pass it over to Andrew now, and Andrew will go over some coupon liquidity and just what we're seeing in the AOT space as well.
Yeah, thanks, Phil. So yeah, kind of just to touch on exactly what Phil was talking about. It has been more orderly in kind of the drop, but still, I think even with the more orderly drop, it's still been a little bit too fast I think in everybody's opinion. So one thing that's difficult when the market starts to move away from us this fast is the liquidity on the kind of the non-traded coupons and where new production is starting to filter in. So considering the market's been moving away from us, that's kind of why I wanted to introduce this slide, was to show you exactly where we're seeing the average note rates kind of hit our open pipeline. So I think currently we're looking at it's a 4.76, so call it 4 3/4 note rate as our average note rate. And at the beginning of the year, we were down at a 3 3/8. right? So, I mean, that's a huge move in just one quarter. I mean, you're essentially spanning 3 different coupons for your par coupon in that short time frame. So if you started trading, if you started trading March securities back in January, and you were trading a 2.5 coupon, essentially right now you're going to be trading a 3.5 or a 4 coupon. So definitely interesting to kind of get some feedback from some desks on what they're seeing, and we're really starting. They're actually saying that they're seeing a lot more. They're still seeing more liquidity in the lower coupons than they are in the higher coupons, and that's just a function of where the production lies, right? So sold production right now is primarily being sold off in the 2.5 and the 3 coupon, which is driving the liquidity in those lower coupons. So you're seeing, even though they're pricing at such a discount, we're still seeing investors and aggregators price aggressively down in those coupons, because they're still, they're still pushing through their production as well and getting that out to market. We are starting to see more liquidity in the higher coupons as new production starts to, is flowing up there. One thing that is happening is, with the Fed kind of taking a step back from their purchasing, that really does take a lot of the liquidity out. I think that, even with the runoff, they were looking to get into that 4 coupon, but it was supposed to be, I think it's supposed to be a small percentage of the overall, repurchases that they're doing. So, with that, there's really not a lot of extra demand being supplied by the Fed right now. So those lower coupons are definitely going to start running off, and we're starting to see. I think there's still a couple 2s out there. And I was looking at the overall client base the other day, but definitely in the minority and moving up the stack, and we're starting to see more in the 3.5s and the 4s. One thing that's kind of interesting and hard to kind of swallow is the bid-ask spreads that we're seeing on those higher coupons. So as we get more production into those higher coupons and we start to see more trading in those higher coupons, those bid-ask spreads will definitely start to compress. But right now, especially on the government side, we're seeing some pretty large bid-ask spreads, just given the volatility and given the demand. So
Andrew, we've got a real pertinent question just came in. I figured this would be a good time for you to go over this. From Logan here, Fannie and Freddie are now going up to 6% note rates, and I have loan production slotting into the 5 coupon. Would you recommend hedging these with a 4.5? And also, how are Fannie and Freddie offering these high rates?
Yeah, no, I think that's great question. I think I think they recently just moved up in their note rate stack of available note rates, so they're starting to see more liquidity up at the higher note rates. I think even with those higher note rates, you're still, you're going to have to have a lot of LLPAs for it to make sense to price that high. But I think if you are starting to see demand in that 5% coupon, you could cross hedge it with the 4.5, like you're saying. I don't think there's anything wrong with that. We're seeing durations pretty close to in line on I think it's the 4 and 4.5 and the 5. But another thing you could do if you're an agency seller is to go ahead and take out a cash forward, on those note rates, right? If you have, let's say you got 5-10 million that is going to kind of flow through in the next 30 days, take out a forward commitment and use that as a hedge instead of using the TBAs, because just looking at the 4.5 right now, you got a 6+ bid ask. Granted, like I said, I think with more production coming through, we're going to see that compress over time. But if it's going to happen in 30 days, 45 days, a safe bet would be to take out an agency forward to kind of cover that production. Yeah, if we could go to the next slide, Phil. So I think today is a great example of this first point. I was talking to Phil and Justin right before this call, and I think we started out negative on the day compared to yesterday, and then I think we rallied. I was taking some time stamp. So um, let's see here. So in the morning, rallied up to about 7:15 Pacific time. Rallied up from where we opened at 5 o'clock, about 90 basis points. From there, for the next hour, we dropped about 40 basis points. And then, from about 8:15 to current, I think we're up about call it another 10 or 11 ticks. So right there, I mean, that's, what are we looking at? 164 basis point move, just in the morning today. So I think getting on top of your production and trading to where your production is coming in, I think makes a lot of sense right now, especially with the volatility. You want to make sure that you're taking advantage of, when these locks are coming in, kind of making sure that they're kind of marked appropriately with the hedge and the TBA side, to where you're not, so to where you're mitigating your exposure and you're, managing your margin on that production. Because what could potentially happen is, you get a huge influx of production, you don't do a trade, the market sells off, then you put your trade on. Now your margin is essentially eroded by that market movement. So being on top of production, trading more frequently, I think it makes a lot of sense. Um, and I think that tells into this next point. One reason that a lot of people used to do larger block trades, outside of the price efficiency from the broker dealers, was for the ability to do AOTs. Back with the legacy AOT model, you were never able to take $1 million blocks or $500,000 blocks and combine them to do a larger AOT. You always had to have a $10 million, $5 million trade on, and then take a 3 million or 2 million block out of that. And there's no way that you could be able to combine smaller trades in order to make a bigger AOT. So trading more frequently, I think, there are definitely those advantages that I spoke of. And I think the flexibility that we have with the hybrid AOT model, gives you that additional flexibility to do assignments and to trade more frequently, to where you're able to take advantage of these different AOT programs that the investors are offering. So just a couple, quick points on this. This first bullet under, taking advantage of the AOTs, it really is a highlight to the AOT program, because whenever you're doing AOTs, the exposure that you're kind of swapping for your trade side is going to roll into your loans when they get purchased. So if you have, let's just take the current environment, you have 20 million out there and all of it's, 5-6 points in the money, you're not going to get that value or the actual cash for that position until settlement, right? If you were to assign that 20 million, that's 5 or 6 points in the money, that position or that exposure is going to be translated into your loans, and therefore you're going to be able to receive that money a lot sooner. And it also changes the price of the net sell price. So instead of selling a loan at 94, now you're selling a loan at par. So there's a lot of economics that the AOT provides, and there really is a lot of cash flow efficiencies that come into play when you are doing the assignments. I know I was talking to Phil about this yesterday, and really from I guess from a cash flow perspective, you want to be assigning, whether it's a large kind of exposure, a large negative exposure or a large positive exposure, because what that does is that brings that cash forward. Instead of having to wait till settlement, you're able to get that a lot sooner. So I know there's different investors will take different month allocations. But essentially, let's say you had some trades out in May that you're assigning right now, instead of waiting for that May settlement, you're actually going to get that cash sometime when those loans get purchased in April. So from a cash flow perspective, you want to take a look at those efficiencies. And then another thing that's good about doing the assignments is you're having to reset your position. So you're assigning your trade positions at like a 2.5 or a 3 coupon, and then you're resetting at the end of the day to a higher coupon to where your new production is coming in. So kind of talking about the roll swap down below, you're going to get a better economic pickup by assigning your production and then reselling the production in a later month. It's more economically advantageous to you guys to manage your pipeline that way. Before I go too far into that, one thing I did want to touch on is, with the wide bid offer spreads right now, with on the Fannie and on the UM30s and on the jumbos, that right there is mitigated by the assignment, because essentially when you're assigning a trade to the investors, you're able to get the bid price instead of the offer price on that trade. So you're saving that huge bid-ask spread. So, I was looking, like we were talking about on the 4.5, so you got a 5-tick spread right now. So you're essentially saving that spread by assigning that production. So huge advantages right now by taking advantage of the AOT process. And then, yeah, I think just to kind of touch on the market flash that we sent out, earlier, it's pretty much the same points that we've kind of just tried to instill in everybody. Make sure that you're staying on top of production. You want to make sure that you're also discontinuing locks outside of market hours, or you're including additional margin. I think, especially days like today where there is a lot of volatility, and this year there's been a lot of volatility, it really is hard to take on that overnight protection. So either one or two things you guys should be doing to mitigate that is to cut it off prior to market close, make sure you're hedged to that production, or you have a strong understanding of how your loan flow happens after hours. You say, hey, I brought in 10 million so far before market close. I know I'm going to bring in another 4 million. So you trade an additional, 3.5 million to cover that 4 million in incoming production that you're going to get. This is crucial for a lot of West Coast accounts that stay open after market hours, is understanding how your loan origination flows after market. I think a lot of you guys understand how it kind of ebbs and flows and are able to kind of to manage to that. So bid offer spreads that we talked about, definitely want to make sure you're doing the AOTs. Right now I'm trading jumbo 4s, even though there's a big bid ask. But I think it's appropriate, and I think I'm going to be looking to assign that production as soon as it comes up to be sold. And like I said, it's also going to compress here as we get more production flowing into those higher coupons. And then I think the last point here is definitely huge, right? Make sure that you're communicating with the trader, staying on top of production. We want to make sure that everybody's kind of on the same page in terms of what's happening with the open pipeline, what loans are coming in, what loans are being sold off. We just had a discussion on note rate liquidity and what loans, what production needs to be hedged, what production needs to be locked best effort. So I think those are definitely some good points to discuss internally, and then also to make sure that the trader's on board with kind of the secondary policies and procedures and any updates that need to be made. So I know that was kind of a lot of practical information, but any questions, definitely post them here, or you could shoot us an email afterwards, and we'll do our best to get back to you. And with that, I'm going to hand it over to Justin.
Yeah, thanks, Andrew. And guys, Phil and Andrew, really, obviously we're harping on this earlier. So kind of wanted to just visually to see, for everybody to see how impressive pricing is actually tracked, during this sell-off. And so, this first graph here, you'll notice the orange line is just that Fannie 30 3% coupon that Phil had up earlier in the slide deck, quarter to date. Basically the same representation there, over, first quarter to date, for the most part. And then the blue line, we're just taking the 3 3/4 note rate price from the cash window, the agency's cash window, and plotting that out. So you can see they're tracking almost identically, through just about a 5-point sell-off. And 3 3/4, it's a great, great note rate to look at here. We're taking out any, you're stripping out any, variables caused by excess servicing or anything like that. When if you figure a 44 basis point G fee and then the 25 BIP servicing spread on top of that, you're right at 69 basis points. So you're only about 6 basis points over, an excess servicing with that 3 3/4 note rate. So it's a great example of how the agencies have adjusted their price, on this 3 3/4 note rate throughout this whole sell-off here. And then this bottom line here, what we call the note rate spread, or if you've been some of our BAM Marketplace webinars, the security spread. All we're doing is taking the difference between that note rate price and the underlying security that it's slotting into. So this is just the difference, right? And really it's the trend of this line or this security spread, this note rate spread, whatever you want to call it, that illustrates the performance. So you can see, back at the beginning of January, it's about a 43 basis point difference between this security price and the note rate price. And we had, a slight dip of, maybe 10 basis points or so for a couple of weeks. And then we've kind of quickly popped up, and you can see, this is pretty impressive. Literally, this is, probably a 5 or 6 basis point range for almost 2 months now that this particular note rate has stayed within. And at least as of about a week ago, right about 50 basis points. So it's almost 7 basis points stronger than it was at the start of the year. And so just, in layman terms, that actually means you're getting paid up, almost 7 basis points more currently than you were back then. So just extremely stable pricing from the cash window relative to the MBS. And we've got a couple other ones, just to illustrate, even outside of, that 3 3/4 note rate, which is a great example, again, without any excess servicing. Even you start to get into some of these other examples where now we're looking at a 2.5 coupon, right? Because going back to the beginning of January, everybody was kind of pretty much the, close to the par coupon there. Everybody had a lot of production in there. So it's another example of a 3 3/8 note rate, slotting into a 2.5 coupon. Same story, 5-point sell-off. And you can see here, even more stable, that price differential, again, slightly stronger than it was, at the beginning of the year, about a 4 or 5 basis point improvement. So agency pricing has remained, has tracked the underlying MBS that we're hedging with extremely closely. And that's why in MCT, our model is based around hedging with TBAs. It's the most conservative, hedge approach that you can have out there. And again, we've got another one here with the Fannie 2 coupon. Sometimes you might think, to Andrew and Phil's point, one of the positives has been that we still have great liquidity in these lower coupons, which obviously nobody's originating any production here anymore. But, if you look at the TradeWeb screen or Bloomberg screen, the bid-ask spread on a, Fannie 2.5 and Fannie 2 coupons are pretty much the same as, what you're seeing on a Fannie 3.5 and Fannie 4 and even Fannie 3. So liquidity is still great. You would expect that if there was going to be some degradation in pricing, you might even see it on the lower coupons here. But again, we've actually seen an improvement of almost 10 basis points, in this case on a 3% note rate versus that 2% coupon. So, if I think it's about 2/3 of you of our client base, have the ability to sell directly to the Fannie or Freddie cash window. That's great. And, an illustration of, not seeing too much of a P&L impact. There's obviously some other things going on with the changes with the second homes, and the high balance could be causing some noise as you guys are trying to clear some of those out of your pipeline with the new hits. But outside of that, agency pricing has tracked extremely closely, and it's a good thing from a P&L standpoint, right? And if you go to the next slide, Phil, we'll kind of show, even the aggregator pricing has tracked pretty closely as well. I mean, all we're doing here, same kind of quarterly view, right? We're plotting out an agency retained price there in blue, SMP, so just your co-issue, agency co-issue pricing, and then the black line here, your aggregator pricing. I mean, you can see they're all pretty much in tandem, within a pretty close range, during this sell-off, and even, the brief rally we had in most of February that Phil was talking about. So pretty different, for those of you around during the taper tantrum in 2013, a very different market. It was right around then when bulk bidding really started getting popular. But, back then, I think we had, 5 to 10 investors, maybe. And I know a lot of you back then didn't have the ability to sell directly to the cash window with Fannie and Freddie. And so, you might have sent out bid tapes to, 5 different investors. So there was, less diversification, if you will, among investors. I remember one investor in particular back then who was extremely aggressive, and a lot of times would be through other investor pricing by 50 to 100 basis points. And then when we had that extreme sell-off, they widened margins out and pulled back completely. And so, a lot of you have some scar tissue from there. We certainly remember it, but much different time period where you had mark to markets take a huge hit, and P&L as well when going to actually execute. And it's a different story now when I know a lot of you are sending out bids to 20 plus investors and looking at, your Fannie and Freddie cash window pricing as well. Your execution has been holding in there pretty tightly with where the market's going. So even though it's been ugly and there's been a lot of low numbers, it's for the most part pretty in line with, what we'd expect with where this market has gone. So that's been the good news. And at least for now, no reason to think that would change. Bill, you want to go to the next slide? That being said, with the extreme shift in the market coupon, I think, especially second half of last year, we were all trading Fannie 2s, and now we're trading Fannie 4s, and probably even getting to trading some 4.5s fairly soon. That shift does present some of the challenges that Andrew talked about. When you're getting that shift so quickly, right? You've got these end buyers, be it on the whole loan side or from a servicing standpoint, or, trying to figure out, true servicing valuation, on these newer, higher coupons with the volatility and the market gyrating as much as it is. And anytime you get the intraday volatility, you will see a little bit of margin added from the aggregators to protect themselves. And so, when we talk about BAM Marketplace, it's definitely a great solution during these transitioning markets, because at the end of the day, it's providing transparency, right? Your view is limited to the current investor set that you have. And so, those of you who are participating in BAM Marketplace, you're getting to see executions outside of folks you're already approved with. And the biggest advantage we see right now are those premium note rates. So, this heat map that you're looking at here just looking at loans that have been sold off in the last 2 months or so. And really what it illustrates, if you see, on average, BAM marketplace investors over that time, when loans are committed to an investor, they're picking up about 16 basis points. But if you'll look, we stratify this out by those different note rate ranges. So, 1.5% to 2%, 2 to 2.5%, so on and so forth. You'll notice once you get over 4%, and certainly over 4.5%, that average pickup, that gain to be had, is more than double the average. And that just illustrates that at the end of the day, with this, quick moving market, again, there's going to be, less liquidity in these higher note rates while they're still, trying to get liquid. And BAM marketplace is just a great way to, make sure you're not missing out on the execution. For those of you who are fully reliant on aggregators, even though the pricing is tracked closely, there's definitely going to be some opportunities here. So keep an eye out for that. And again, even in the Govy space, you'll see in some pretty high numbers there. So a lot of moving parts, especially with the Govy when you talk about spec values and whatnot, as those have experienced some volatility. So again, just a great way, if you're not participating, to get some transparency into the market and other executions that you may be missing out on. At the very least, at least making sure that your existing investor set is strong and that you're not missing out on anything. So keep an eye out. We would expect as these higher note rates get more liquid that that'll compress. But in the meantime, there's certainly some opportunities there, and everybody should be taking a look. So with that, I think, Phil, I'll pass it back to you to.
Well, thank you, Justin. That was
here.
great, and great job from Andrew as well, talking about specific trade desk recommendations. I did want to go back to a couple of Justin's slides here, and look, Justin spiked the football a little bit on TBA, on why we hedge with TBAs. But look, for those of you that have been clients of ours for 15, 20 years. Every time we come through a period of substantial volatility, we always go back to this, that if you just look at, what Justin just showed here, that's a 5-point move on, and you have basically the note rate spread in this example, moving positive 4 basis points. So what that means is, every 100 basis points that the price moved, there was only a difference of hedge movement versus asset movement versus your pipeline execution movement of 1 basis point. Like Justin said, other things going on, no question. There's additional adjustments, there's pull-through characteristics. Obviously, every borrower who knows anything, who has a television or an internet connection, is probably doing everything humanly possible to close their loans. So that's going to be a profitability, impingement there. But just from a standpoint of TBAs versus, you'll hear the people in the industry talk about hedging with treasuries. Some of you guys might have seen Christopher Waller's the Fed governor talk last week regarding where the Fed wants to take their not just their purchases, of which they're just replenishing runoff right now in the MBS space, but where do they want their balance sheet. And at the end of the day, he reaffirmed that the Fed eventually wants its balance sheet to be treasuries. Now, it might not actually actively sell MBS soon, but at the end of the day, they still want that policy that their actual true balance sheet will be eventually treasuries. If you're thinking of the prospects of hedging with treasuries, when you have mortgages unwinding, so basically spreads to treasuries going wider, so mortgages underperforming, that's your asset that you're long. So that's your position you want to go in the money. It's underperforming, and you have your treasury in this example basically overperforming. So that's what we call a bad hedge. And so I think that, again, it's not, there are certain cases with ARMs and maybe some, some non-agency product that we can look at some of these instruments. But I think it is important, because there always is a look, especially when we go through rallies, there's a tendency to look at, hey, can I do some treasury options? Potentially reduce my pair off. There's expenses that we've gone through before in past webinars associated with that. But it's important to understand that when the volatility hits, this is the safest hedge. It's mathematically indisputable. So I think that's important. And I also want to just, Justin's graph here on aggregator pricing and just how, strong that's been. In May and June of 2013 and also in March of 2020, we were pretty critical of the aggregator industry. MCT was, and rightfully so, right? That the aggregators had not, had not followed the market. One of the benefits of 2013, Justin mentioned, 5 investors. I mean, for those of you that there were just, in 2012, there was really one aggregator that was, a depository that was holding the market together. 2013, there was a couple more. But the taper tantrum of 2013 created the MSR asset to be, kind of an in vogue asset again. And of course, that's really what led to the proliferation of the aggregator space. So if you just look at this graph and how well, they've followed the market, the aggregators have, we're in a much healthier position, and the aggregator community should be complimented for that it's a far more, because of the competitiveness, it's a far more liquid and efficient market, even if you're an aggregator only seller, as in you don't have agency approval. So look, just in summary here, we beat on the market decline, comparing and contrasting it versus 2013. Definitely investor pricing and agency pricing seem to be really in line. I think the specific trading recommendations that Andrew talked about are essential. Talk to your MCT trader if you have questions on some of the stuff that Andrew talked about. I know some of it was a little bit technical. In those bid offer spreads, you're going to continue to see transitioning coupons here, right? Like Andrew talked about, and like Logan's question had said, Logan's out there originating product in the 5 coupon, which basically you need to do if you're doing non-owner purchases right now, where money's not brought to closing. You've got you got to be way up in coupon right now, considering that the only thing north of par right now that the Fed is buying is the 4 coupon. And so we do have some, it's just a transitional period. This will this will eventually settle out in the next 30 to 60 days. But right now you've got some inefficient coupons that are actually market coupons, like a 4.5 coupon. And so it's important to be AOTing, especially in those inefficient government coupons. And I wanted to talk about a little bit about volume here. For those of you that were at our exchange, we talked about the lock volume indices, and look, the MBA indice will always, it will continue to be the overall market indice, but it's becoming more and more, given where we currently are and where the purchase market is, especially for our client base, you guys on the line right now, it's becoming a little bit inaccurate. And again, this is nothing against the MBA's index. It's more just how the index is weighted versus as a whole the MCT client midsize lender pipeline. And so I just want to, just going back to last Wednesday's announcement, the first thing that they talk about is that, refis year over year are down 54%. That's definitely true, but it doesn't break out the key components of the refis, right? Which are rate term versus cash out. So if you look at the red line here, year over year, we are down 83% year over year in rate terms, but we're only down 25% in cash outs. Now, looking forward, you can see by that green line, which is the cash outs, cash outs are starting to capitulate a little bit here as you start to get into these very very high rates. But it's important to break those out, and more importantly, and this is really what represents the difference between the index that we are going to be communicating and pushing to you guys and that you'll have available in MCT Live versus the MBA index is the purchase index. Last week, they said their purchases are down year over year 12%. You guys as a whole are up year over year 11%. It's literally a polarity difference. That you're up by the same amount that their index is down. That is, as you guys know, that is simply a fact that the MBA index, covering 75% of all applications, is more heavily weighted to consumer direct. Consumer direct still does not do good in a purchase market versus retail. And so it's the reason that we're going to be pushing these indexes and the ability in MCT Live that you can compare your volume index to the MCT client base index is that we do expect, as I think a lot of you expect, we do expect to see volume differences, volume changes occur as especially if we continue to decline or if we just stay here in rates. Specifically on the cash outs, we would expect to see continued capitulation there, and then obviously the $3 trillion market question is where purchases are going to go. But I think it gives you a more more accurate kind of comparison and benchmark of where your volume is versus where your peers are. So with that, I really appreciate everybody's time. It looks like we do have another question here. We've got a question from Ira. Let's see here. Thoughts on moving some locks over to best efforts, especially if volume isn't supporting AOT executions as well as the lower BE to mandatory spread. Andrew, maybe you can take that one and talk to us a little bit about some of the benefits of the newer AOT programs.
Yeah, no, it's a good point, and there's I think for some of the liquid production, it might make sense to move to a best effort lock. But I mean, right now, as long as you have multiple investor outlets for that production, then I would still want to keep that in the hedge and still hedge that. The additional functionality that Phil was talking about is some investors will allow you to do cross coupon AOTs. So even if you have, let's say you have a loan in the 2 coupon and you want to do assign that loan into a trade, and you had another loan in a 3 coupon, you could essentially blend the two together. So you could have, let's say it's a total of $1 million between that loan in the 2 and that loan in the 3. You could still assign them $1 million to the 3 coupon to get some assignment for that trade product, for that loan production. So there are investors that allow for that blending of coupons during the hedge or during the AOT process. So yeah, if you have any specific questions on which investors are allowing those, definitely reach out to the trader, or you could, like I said, just shoot me an email and I can get that to you as well.
And here's a good question from Patrick. What's the best way to handle extensions for rate locks that are covered through forward commitments? And And I think that, that's an interesting one, Andrew, because it under, it's another benefit of the TBA, right? That we have the flexibility there. But Andrew, would you just want to put more of a buffer on your commitment or on your forward?
Yeah, and that's one thing about forward commitments is you want to make sure that you're setting it out far enough to kind of have the production incoming to deliver into it. If you do run into a scenario where you have you have an outstanding amount, call it 200, 300,000, and you have a loan that looks perfect for it, but then that loan gets extended past your commitment window, then essentially you're just going to have to pair out of that commitment and then take out a new commitment for new forward commitment for it, if it's specific to that one loan, right? And that's what's another thing about forward commitments is that you're losing the spec piece of that production, right? So you don't want to take any loans that fit into a spec bucket and deliver those into a straight forward commitment, because you're going to be losing out on that profitability for that spec. So you'd want to deliver those as a spec and then pair out of whatever you have as a forward, if that is the case.
Yeah, and what Andrew said there about pairing out of that commitment, right, and resetting it really is the foundation of Patrick's question there. That at the agency level, there are two-way pair-offs, right, and they'll give you, but if you were to do that with an aggregator, the vast majority of aggregators, it's a one-way pair-off. So think about the position that you're in right now. Yeah. You've got you've got this hedged commitment that theoretically could be in the money 5 points right now. You completely lose that in a one-way pair off situation where you just don't owe any money, but you lose those 5 points. So that's essential to understand that about forward commitments, and I think a great question. Andrew, one more from Kelly here on lock extensions. Do you see a max number of days that that a lock should be extended?
That is the benefit of hedging. Using TBAs, as Phil was talking about, is you do have more flexibility when it comes to lock extensions, right? Essentially, if you have a lock that's set to expire, in April, and you're hedging it with April security, then all of a sudden they want to hedge it or they want to extend it another 15, 30 days. That would reset your hedge position to go out into a May position. As long as you're covering the cost of it appropriately, and I think with most of your lock extension policies that you guys are covering the cost of it, then I think it's fine. So I think just make sure that the extension policy that you guys have in place is covering your hedge cost. And one thing to take into account right now is the wide bid-ask spreads. So if you do have to reset into a future month, now you're having to take that offer at a wider bid-ask spread and then associate that with a new trade position, in May. So you want to relook at that cost of hedging a loan right now, because if you're building in, call it 0.8 basis points a day, which I think was appropriate for 2021. I think right now it's a little bit wider. You're probably at like 1.2 basis points a day. So it's definitely widened out. So take a look at the bid-ask spread, and then also take a look at the expansion of the price between the months that we're delivering into. I think it was close to 8 ticks, and I think it blew out to 10 or 11 ticks between the month drops. So look at it. You got to take kind of all those things into account whenever you're looking at extending a lock. But as long as you're pricing it appropriately to the hedge, then you could kind of continue to put it out as long as you're covering the cost of it. If that makes sense. Hopefully that makes sense. But like I said, you could definitely reach out to me, or we could set up a call to kind of go over it in more detail, Kelly.
No, that and that was extremely detailed. I think in one additional point there that Andrew's talking about, as long as you're charging for it, you know, that's the benefit that we have in the current market, where we still have good liquidity. I think, Andrew, you know, as soon as you guys start to be concerned about, let's say note rates under, you know, 3.25, for instance, you guys may change that, where it's you don't want to continue to extend this into perpetuity, right?
Oh, that's a great call, Phil. Yeah, something where we're worried about note rate liquidity. That's where it comes. You know, you just have to cut off the lock extensions and say you're gonna have to lock on a worst case basis at that point in time, right? Because you don't want to be sitting there like Phil's saying with a 3.25 note rate, and then all of a sudden that just goes away, and now you're stuck with that on your books, and you're gonna have to, you know, sell it scratch and dent, or, you know, at a discount to these investors. So yeah, there's a lot of things to take into account, and I would definitely agree with Phil. Like, note rate liquidity is key. You know, when you're looking at doing the lock extensions.
Well, that's awesome. Yeah, it looks like we're out of questions, and that's perfect because we're a minute over time. Guys, I really appreciate it. We are going to definitely continue to communicate through the market flashes. We will be having another webinar, and it could be within probably about 2 weeks. Kind of once the market settles out here, and we have some more information on where this thing's going to go. But with that said, you know, just specific to what Andrew was just talking about note rate liquidity, if anything does change in the lower coupon liquidity, we'll definitely be communicating from the trade desk immediately. But really want to thank Andrew and Justin, and thank you guys all for participating in our webinar. Thanks, guys.
Thank you, guys.
Thanks, everybody.